That's a ridiculous amount of growth. I mean, some of us spent, 15 years in industry working from individual contributor, technical contributor, all the way through, management to general management. I mean, that's a long process. And to be thrown into, here, start a company, here, hire some people, here, manage these people. That's a ridiculous ramp.
So welcome to this week's Leaders on a Mission. I'm your host, Simon Leach, and this is where we spotlight innovators shaping the future. And really pumped about today's guest. So excited to speak with Josh Posamentier, co-founder and managing partner of Congruent Ventures. Just checking Congruent Ventures out, right? Since 2017, they've deployed, I think, in the region of about $300 million worth of capital and invested in, I think, circa around 60 companies. And that's really broadly across energy, food systems, and mobility to combat the climate crisis. So really looking forward to exploring Congruent's mission, chatting through the evolving climate tech landscape, and I suppose hearing Josh's advice for entrepreneurs, really breaking into this space as well. So whether you're a founder, investor, or passionate about sustainability, this is a conversation you won't want to miss. And Josh, I know you're a very busy man, so really appreciate you coming on and sharing your time today.
Happy to be here.
Awesome. So maybe just give me maybe share with me just some maybe a personal, professional journey that I suppose led to you founding Congruent Ventures in 2017. What brought you to it?
So my journey, like a lot of people in venture, was not particularly linear. So my academic background was all physics originally. Spent about a decade in the semiconductor world, touching things from early wireless networks to optical telecom to eventually corporate venture and incubation at Intel. And then jumped out to business school where I decided the grass was greener on the other side and started a company in the software space and mobility. It was an interesting time to do that in 2007, 2008. Wouldn't recommend. But that ultimately turned out okay, sold that, and specifically decided to get into energy. And it turns out energy plus, if you like cars, there's really just one option. So I ended up at another big semiconductor company to go build a business focused on electric vehicles to start with, and ended up doing that for almost 5 years from scratch. Kind of put together, business really focused initially on the battery side of things. Electric cars have about 10x the silicon content of gas cars. So interesting market, but I learned all about, batteries, power electronics, energy storage, grid interconnects, ended up inheriting the smart grid business unit as well. And that was my entree into the energy space. After that company was acquired, had a little bit of a pattern here. I decided to jump out and join a friend of mine from business school at another venture firm that ultimately turned into what's now called Prelude Ventures. Prelude Ventures is also in the climate space, but multi-stage. And one of the things that became pretty clear while I was there, this is from 2011, 2012 to 2017, is post clean tech bubble implosion, the number and quality of investors in the climate space had really kind of fallen off pretty dramatically. And as a multi-stage fund, we're looking constantly for early stage deal flow. And one of the challenges with, the space getting really sparse was we just weren't finding everything we were looking for. And so, we tried some experiments internally with a more streamlined seed process, but it wasn't a good fit. And so we started looking outside. And as I was leading that process, the more time and cycles I spent looking at the opportunity for early stage climate investing, the more attractive it became. And eventually I pulled in a friend, Abe Yokel, who's my co-founder at Congruent. And the two of us got it off the ground late 2016, early 2017 to really specifically focus on building an institutional grade, climate focused early stage fund. And I think we've pretty much done exactly that. And we're still investing in the same four sectors we wanted to invest in to begin with at the same stage. I think there's a few things that evolved slightly differently than we expected, but all in all, it seems like that was a good spot to be. We're far from the only ones at this point, but back in 2017, you could count the early stage climate investors that weren't just straight angels, on one hand. And so there's different times, but even today, there's probably more high quality early stage deals than there's capital to chase. So it's a first class problem.
Yeah. When you talk about the implosion, are you talking about the kind of, climate tech 1.0? What kind of years are we talking about that implosion?
So I think that implosion really got going and kind of concluded in sort of 2008, roughly.
Okay. Yeah. Yeah. Okay. So it's really interesting, I think, from your viewpoint. You've been, really across that value chain. As clearly you've been involved with a number of companies that you've mentioned that you've kind of gone on to exit with. What's the fundamental difference, I suppose, when you're thinking about going to run and be an operator as opposed to kind of an investor? How do you kind of weigh out the kind of pros and cons of each, do you think?
Well, I would say that was actually probably one of the toughest things to kind of reconcile, switching sides of the table, going from an operator to a venture investor. There's a degree of trust there, and then I think the biggest thing you learn and the biggest thing you orient around is really laser focusing on high quality teams that you can trust and do a good job. Investing in teams, I think we've all kind of been there at some point in our venture career. Investing in teams you think can, will suffice for the time being, but maybe not take a company the distance, is almost always a recipe for disaster, because it's not your job as a board member or an investor to fix the stuff you deliberately invested in, sort of wrong. You definitely want to invest in companies for the duration, invest in teams that you can back from start to finish. I mean, the reality is not everyone is going to make it from a company leadership perspective, from pre-seed through IPO, but you want to make the investments where that's at least an option, and that's kind of how we orient around for Congruent.
Yeah, no, got it. And well, there's lots to chat about that. I mean, I'm just going to dive straight in because you just mentioned a couple of things there. But surely, when you're investing in kind of a seed or pre-seed kind of round, at that point that the leadership team is not in place that's going to go there on the kind of journey. So no doubt you have to delegate a lot of faith and kind of trust in what you believe the leadership philosophy of the strength of that leader, that they're going to be able to kind of execute that, I figure.
Yeah. I mean, I think, so I kind of think of it in terms of like the superpowers of the best, venture entrepreneurs. They have a few superpowers. Like, number one, they're really good communicators. This is just table stakes. Number two, they attract amazing talent and convince talent that has no business joining an early stage startup because it's just they're outclassed. They manage to convince, they have the reality distortion field, and they convince these people to join. And you feel like you've just had just this massive unfair advantage descend upon your company, which is just a wonderful feeling. We look at the most successful companies in our portfolio, and this happens repeatedly. I mean, it's definitely a clear pattern. Then we look at people who are introspective and really have a strong kind of growth mindset. I look at some of our entrepreneurs across the portfolio that literally started a company right out of grad school or right out of their postdoc, have never actually worked at a company and had to figure all of this stuff out on the fly. That's a ridiculous amount of growth. I mean, some of us spent 15 years in industry working from individual contributor, technical contributor, all the way through management to general management. I mean, that's a long process, and to be thrown into here, start a company. Here, hire some people. Here, manage these people. That's a ridiculous ramp. And so the best entrepreneurs really jump in with both feet and really go into it, not thinking they know everything. I mean, let's say they've been through it a few dozen times. That's a different story. But most of our entrepreneurs are first timers. And you can see, and we don't always get it right, but you can usually see that pattern right out of the gate. It's, the pitch you get is not a pitch. It's a conversation. And it's compelling, and it's data-based. And those things, that engagement early on, you know within minutes oftentimes, and seldom has that been wrong.
Right. So it's very much a kind of gut feel as well, right? And you see that early on, right? Because we're always analyzing these things super intently, right? So
yeah, no, it is. There's a massive subjective element here, and that's not. I mean, I'm not saying we would just invest in anyone, like no matter what they were doing. I mean, the objective elements are: is it a big market? Is venture the appropriate tool for this? There's amazing entrepreneurs doing things that venture is 100% the wrong tool for, and that's fine. Like when you're working on climate change, most of the dollars getting deployed into the sector are not going to be venture in any case. And so there's tons of opportunity for businesses to thrive without, our particular tool set. So we're looking for entrepreneurs who also recognize when venture is or is not the right tool set. So, so the objective things are big market, good margins, fast growth potential, nonlinear scaling with input dollars. And that's not super complicated, but the subjective part is necessary, but not sufficient, but really, really necessary.
Yeah. No, great. And great perspective. And also for you, I know you mentioned like when it was interesting looking at your background in investing as well. So I suppose with Congruent Ventures, you mentioned that there was a gap there on the early stage side of things. What else do you think, when you looked at the venture capital landscape, were there any other kind of aspects or gaps that you felt you wanted to kind of plug? When it came to maybe opportunities, within climate tech?
Yeah, there's a couple. So when we were first starting out, there were two. I mean, we were just focused on the beginning part. So there were two main gaps we were focused on. Number one, that sort of the capital for inception. So first money in. So 3/4 of the deals we do were first institutional check into those companies. That was really the core gap we were trying to plug. The second gap, which kind of still exists today, although slightly different, is that next stage of capital where you have an MVP and you need to get it into market. It's classic Series A. So you have a minimum viable product. You're trying to get into market. You're not at the point where you have a repeatable sales process or ICP that you can just put money on to scale. And so that next gap, that's still a hole in the market. But what we did originally, recognizing that gap also existed, is we built our LP base out of groups that had not exclusively, but largely out of groups that had a very specific co-investment interest, in the hopes that we do the first deal, the first round, maybe the next one, and then we start bringing LPs in to help plug that gap. And that was the model. That hasn't been nearly as necessary as we thought it was, but it's still. So we call that the missing middle right now. Or there's lots of missing middles, but that's the one we talk about when we're talking about a missing middle. So in the venture spectrum, that feels like the biggest gap today, which is that sort of classic, mid-Series A round. The other gap that also exists, though is not exactly a venture gap, is the first of a kind plant financing, which you'll hear people talking about as FOAK, first of a kind, or SOAK, second of a kind. That's also a pretty significant gap in the market.
Absolutely. And so tell me that first gap, the mid-Series A, and no doubt Series B and Series C as well, I would have thought as well. Well, that probably moves into the plant financing, I would have thought, somewhere along that line.
It gets there. There are significantly more firms out there that are comfortable investing after companies hit 5 to 10 million of revenue, and so that's sort of the classic late Series B, Series C, and beyond. And what we're seeing is with companies that have sort of a high quality, repeatable sales process and reasonable margins, we're seeing pretty clearly that there's plenty of capital out there for those investments. In fact, I would say something approaching a dog pile. Everyone's in search of the high quality deals in the sector, and there's a lot coming, but not many are there yet.
Yeah. I think what's interesting. I'd love to just hear your view. I hear a lot of CEOs looking for investment. Clearly, it's taken them a lot longer, to close a round. I mean, I don't know what the stats exactly are, but spending a lot of time, 80% of their job on financing, and I hear like 90% of stuff gets stuck a little bit, where maybe investors are having a look. There's not quite the FOMO. And you hear a lot of people struggling to move things across the line and, get the momentum going. Is there anything a CEO can do, when things are a little bit stalled or stuck, do you think, to really kind of help with that?
There's all sorts of reasons why that can happen. There's a ton of reasons. I mean, everything from, and you're not going to hear it from potential investors also, right? In general, if your last round was done in 2001, 2002, you might valuations have been have adjusted pretty substantially. So that's a huge challenge and not something people often want to deal with. So I think having an inside syndicate in those cases, I mean, this is again something we've done. Having an inside syndicate that's willing to basically do a valuation reset, do a small inside round if necessary, is incredibly helpful to the market. And oftentimes we've seen just catalyzes around to come together. No one wants to tell you your baby's ugly, but if that's the case, then you need to be able to resolve that in some way. So that's one thing. Living to fight another day, again, depending on the situation, basically getting more points on the board, getting a company further down the line, even if it means, cutting future, product development, just laser focusing on what you have now. It's really, people need to see something, I think at this point, depending on the stage, that's starting to scale or has clear indicators, clear metrics that indicates that it's about to scale. And so that's just a matter of getting those things, demonstrating those things materially. Gone are the days of, a team and a prayer. You need to actually show. It's a little bit of a return to quality from the venture perspective, from the days of irrational exuberance, I would say.
Yeah. Okay. No, great. And just a couple of things about the fund, right? So I hear a lot about funds investing, particularly with for instance. An impact fund as opposed to a financial fund, as it were. And I know you've got quite a lot of information on your website about impact. So I wanted to just understand how you kind of marry those sides and what your focus is as a fund.
Yeah. I mean, climate funds investing in the climate sector, you span the gamut from, we see the gamut from like pure impact concessionary capital to just happens to be in the sector, but laser focused on returns. We tend to skew pretty hard towards the returns side of the spectrum, rather than the concessionary capital pure impact side. But the way we sort of modulate that is with a pretty rigorous initial underwrite. We don't have a hurdle or anything. Some funds have a hurdle where it's like companies have to hit X gigatons of carbon reduction per year in order to hit the mandate, or they have a portfolio level goal. We don't have any of those things. What we see is everything in our portfolio goes through a kind of a stage gate on the underwrite side, where we say, look, it's intentionally and materially impactful in some dimension. So it's greenhouse gas negative, it's pollution negative, it's circularity, it's water reduction, it's some pollutant reduction. Those things are all, there's no greenwashing with that. They're all measurable in some way. Some things are much harder to measure than others, but they're incontrovertibly climate positive. If you have a technology company that's focused on making the grid more resilient and able to accept more renewable generation, more intermittent renewables, it's really hard to measure the carbon impact of that company, but there's no question that it's good for the sector. So that's why we don't have a specific hurdle. We also think that if we show, high quality, top decile, top quartile venture returns in climate, that's just going to catalyze more capital into the space, which we all need. So we're really, really focused on being returns oriented and institutional grade, really to encourage more capital to form in this space, not just for us, but for everyone.
Yeah, got it. And you mentioned earlier about your thesis. Initially, and you're roughly in the same space. You spoke about food and food systems, mobility and energy. So, just talk a little bit like the thing that strikes me about that, and I see you sit on a lot of boards of companies across those different sectors. So I'd love to just understand how you see things vis-a-vis, the similarities between some of these kind of different, the similarities and the differences between some of these different sectors, as it were?
Sure. So they are potentially pretty different. I mean, I guess for better or worse, the way I often think of these companies is like, what are the ways they'll fall down, and what are the problems they're going to have? I mean, everyone's got to find the best team and got to figure out how to hire them and pay them for, and afford them, basically. The way these companies almost all have, one of their biggest risks across the spectrum, and this is something that's shared across all 4 of our verticals, is not necessarily understanding and being as clear as possible with the path to market. So that's channel, that's the GTM strategy, that's something along those lines. It's really, whether you're a food and CPG company and you have a very classic channel that includes distributors and retailers and consumers, to you're an energy company that has to develop energy projects and deal with the local utility for an interconnect, the ISO for dispatch, your off-takers. It's just incredibly complicated. You can screw that up in any number of ways. Now, the way they screw it up is often different, but when we focus on early stage companies, that's one of the places. We're not going to add a ton on technology development. We're investing in companies that usually know the technology they're developing better than anyone else in the world, so they're usually pretty good on that. But where they often lack nuance or lack experience, and something we've seen repeatedly is really this laser focus on go-to-market and channel strategy and all of that stuff. Oftentimes, companies get to an MVP, ship it, find some early customers, they love it, and they can't figure out how to get from 1 to 10. And that is shared across the board.
How should companies approach that question and issue then, do you think?
If I had that answer consistently, I'd be really rich. But no, I think there's lots of schools of thought. There's no substitute for talking to as many customers as possible. I think just as much interaction with the market and the channel, but not just customers, but everyone in the value channel, everyone along the chain. You got to spend time with and really understand who benefits and how from your technology, your company, whatever you're shipping. I mean, you got to make it win-win up and down the board. You can't have gatekeepers that are just out to get you. And it's not trivial. I mean, sometimes that's pretty linear, like everyone's going to benefit from this type of technology or that technology. But sometimes there's someone that's going to lose because you're going to win. And you got to figure out how to, make your solution more attractive to all the other, gatekeepers along the way. And they can be subtle about it. So really just spending time. I mean, I can't encourage entrepreneurs enough to spend time focusing on their channel and watching others, what's worked in the past, learn from others' mistakes. It's just, it's hard to see sometimes, but it is definitely priceless.
Yeah. Well, there are a lot of mistakes that have been made over the years. Well, a lot of lessons to be learned over the years.
All the same. Yep.
Yeah. It strikes me. I'm wondering if you ever see this with some of the entrepreneurs you invest in. As you invest so early, you said their first time, they're probably normally technically proficient as it relates to the ownership of the technology, as it were. So is there sometimes that blind spot towards, we've got tech, isn't it wonderful and shiny? And it's that second piece in terms of, as you've mentioned, the go-to-market and the commercialization. And that's just not naturally the skill set, is it?
It's not the skill set, but you can usually see early on if it's the orientation of the entrepreneur, like the very technical entrepreneur, to be really curious about that stuff and to really be interested and really and excited to talk about it. The opposite of that is the if we build it, they will come. School of entrepreneurship that seldom works unless you're like just selling a commodity into a commodity market, which is fine. You can do that, but that's probably you're going to have to do something pretty dramatically different to get us excited. Purely, But no, it's I can think of a few entrepreneurs in our portfolio that literally had never worked at a company in their lives, and came out of PhD or postdoc really excited to actually solve customer problems. It's like I see this really big problem in the field, and I've got this cool technology. I think this is the best solution for that. Best mousetrap doesn't always win, but really focusing on actually how to get into that market and being really attentive to if something's not working, pivoting in an agile way. Those are the best entrepreneurs. I mean, we've got some amazing pure tech entrepreneurs, and some of them, can solve that problem by partnering with someone that's sort of more business focused, which again, that's to their credit. They've recognized that deficiency and are backfilling. But the best ones, and sometimes it takes them a year or two or 3 or 4 to learn to really embrace. But when they get going, I mean, the best entrepreneurs that deeply technical approach the sales problem like an engineering problem. And it's never pure engineering, right? There's always a massive subjective element to that and a human element. But approaching it in a systematic way usually yields good results.
Yeah. No, great. I mentioned earlier about how quickly you guys have made progress with deploying capital and numbers of companies. Now, I suppose as you look back from 16, what have been the most impactful milestones that you kind of reflect on for Congruent?
I mean, I think the right way to judge a venture firm is not by how much capital you manage, but by how the portfolio is doing. I mean, as I said, like 3/4 of the companies we invest in, we're first check in. Many of those are hitting Series Ds in market, making tens of millions plus of revenue. Some are even profitable at this point. They employ a few thousand people from usually a couple of people and a dog in a garage to start with. That's immensely satisfying. Watching and of course it's every company is in a sector that actually matters to the world. So they're generating carbon-free electricity. They're making it easier to electrify things, easier to finance clean energy assets. There's just like lots of different ways these companies are actually going to benefit society. So watching them grow and scale and succeed and do good things, like that's just like a great win-win-win.
Absolutely. Can we maybe just look at an example then of, I don't know, a company that you've invested in quite early and, that has developed, quite well? It'd be great just to, just understand that in a bit more detail.
Yeah. I mean, on the very, very clean story side of things, it's been in the news recently. Fervo Energy is a geothermal energy company. Geothermal is a space that people often love to, kind of hate. It hasn't, historically has not been a great set of investments. But when I met Tim and Jack at Fervo, Tim was still in grad school. I think Jack had just finished his PhD, and they were, super early, just two guys, and we're like, we're going to use the billions of dollars of investment in R&D investment from oil and gas, unconventional oil and gas, and apply it to geothermal. And you look at the grid and you're like, wind and solar are super duper cheap. The problem is they're intermittent. They're somewhat predictable. They're still intermittent, and you need a carbon-free baseload to dovetail with that. Nuclear might be one, but geothermal and hydro are kind of the other stalwarts in that space. But geothermal has been kind of flatlined for many years. And so being able to, improve that sector dramatically is something that, seemed really appealing. But at the end of the day, you had a team that would just absolutely had the entitlement to win here. You had, I'll get to the personality sets, but, Jack had actually worked on, remediating the geysers project, which is, one of the Northern California, I think one of the biggest geothermal projects in the world that had experienced a lot of thermal decline and just wasn't performing. And so, you have some direct experience there, mitigating the one thing that's, a real challenge for geothermal. And then you have Tim, who'd been a well completions engineer at BHP and had gone back to business school to kind of really leverage that to start something else. And that combination of skill set, and honestly, they were early career guys. They'd never run a company. Watching them get into it, hire, I would say, off the beaten path A+ talent, and then continue to do that. We co-led the A, which was sort of the first real round, and have been pretty substantial participants ever since. Watch that arc, watch them navigate, a really complex go-to-market strategy where you can't just raise, $150 million and build a whole project. You have to do a crawl, walk, run, and they de-risk the projects all along the way. And that whole process really reflected almost exclusively on the team's, sophistication and wherewithal. We've had geothermal startups before, and nothing has come close to the level of execution these guys have had. So you took something that had, limited IP. They do have IP, legitimate IP, but most of it is like just awesome execution. And that just goes to the quality of the team and the team they've built. So again, just watching that in action has been amazing.
Yeah, no, great. No, thank you for that. So where have they got to then? When you just finishing off with that one, where has that company got to when it comes to the decarbonisation story and being able to kind of, really drive a successful go-to-market, as it were?
So this falls into the, a little bit of the selling commodities to commodity buyers. Your energy is, differentiated only insofar as where it is and, sort of the carbon footprint. Every electron otherwise functionally the same. But they've done an awesome job of really navigating the buyer market there. First customers are mostly California. Well, technically, first customer was Google, so they managed to, sign Google up to a very, very small subscale offtake from their first project. But on the back of that, and in some of the navigation they've done, they've managed to deal with a challenging interconnect regime. Right, everyone has probably in the energy space is well aware of how much difficulty there is in getting an interconnect for new generation assets to the grid and getting it commissioned and turned on. One of the problems with one of their favorite sites is, the interconnect date is still way out there in the future. The site they pivoted to, obviously, like I said, in a very agile manner, got them interconnected far more quickly. It's not the perfect site, but it's high quality resource and it's working out well. So, they pivoted to that, and then they navigated the California buyer's market. There was a load adequacy, requirement that had come up, post our initial investment that drove the explicit need for more firm resources. And geothermal is the one thing you can build quickly. So, little bit of taking advantage of right time, right place.
Awesome.
But it was the one thing that can compellingly solve that problem.
Yeah, no, awesome. Just a couple of questions that come to mind, from my viewpoint. When you invest so early, and then you're on the journey through subsequent rounds, at what point are you thinking about an exit, or are you thinking about showing a profit for your LPs with that, as it were?
Yep, we think about it all the time, but we run a 10-year fund like everybody else, or almost everybody else. But we also have really close relationships with many of our LPs. And so they realize we're in an early stage climate. It is probably the longest timeline, realistically, between, when we invest and when there's a potential exit. We're in value maximization mode. If it takes 10 or 12 years for a company like Fervo to get out the door, go public or whatever, that's fine. We want to really maximize the value, maximize the potential of that company. We and our LPs, who are quite aligned with that, really are laser focused on just maximizing that outcome and not showing sort of early exits. I mean, we've had early exits. I think we've sold 5 or 6 of our companies at this point, some of which had raised very little money coming in, and just opportunities too good to pass up. You just take advantage, and then sometimes backfill with more companies in that space. But yeah, something like AMP is not a flash in the pan. I mean, it takes them years to develop projects, years to prove they are working well, and all along the way, they're building value by building backlog, building more projects. So that we're not in any rush. I wouldn't go so far as to say we're like super patient capital with an infinite timeline. But we've optimized and really oriented expectations around being a source of patient capital that's around for the duration, really wants to maximize the value of those companies in the portfolio. So we're not pushing anything out the door anytime with any real urgency.
Got it. Another question, just thinking, as you're so early, no doubt you must have very good relationships with lots of the labs around California, for instance, and a lot of relationships with founders that come from there. What are the kind of, across all your sectors, if you were thinking about the top 2 or 3 labs that churn them out, churn the high quality talent out, where would they be?
In terms of lab talent, it's almost always university oriented, that, at a university it's coincident with a lab. So like, UC Berkeley and Lawrence Berkeley National Lab are, kind of joined at the hip. There's a lot of really interesting companies that are getting spun out of the combination. It's hard to say where, which side they come out on. Likewise, Stanford and Slack, totally common to see things out there. We see considerably less for most of the other national labs. There are really interesting things going on at PNNL and Los Alamos and INL and Argonne, but not nearly as much entrepreneurship. But I think that's partly just a feature or bug of location. It's just much easier to spin things out of the schools that are co-located with the bulk of the venture investors. MIT, obviously, and Harvard have a couple of different, institutes and groups that are really, really innovative and entrepreneurial, and we pay a lot of attention to that. So I think our companies, though, are scattered all over the place. There's not a lot of consistency about where portfolio founders have come from. So it's helpful, but not the only signal for sure.
Yeah. Okay. And let's look at let's look ahead at, maybe a couple of trends or thoughts when you think about, you could even treat them a little bit individually, but when you think about energy, I mean, we've mentioned some of the geothermal kind of stuff. I'd love to hear your thoughts on what you're hot on looking at the future and what you're not so hot on as a subsector of something like energy, for instance.
I'm sure that pun was not intended at all.
No, I didn't even know I did it. What did I say, by the way?
Well, geothermal is always a hot sector.
But. Yeah. I'm not that clever. I'm not that smart, I promise you.
I can't help myself. We've been in that company for a long time. Let's see. Interesting trends. I think, one of the trends that has really, I'd say, accelerated a little bit with the incoming Trump administration is probably a pretty dramatic increase in onshore manufacturing. And with that, we'll see all sorts of efforts around making manufacturing more efficient. There's a lot. I mean, we have a handful of companies already in that space that are doing everything from more efficient metal fabrication and creation to software that makes factories more efficient and waste less, create less loss. Because, among other things, if we don't have access to, Southeast Asia's manufacturing capacity, it's going to have to happen here. And given what you pay people a living wage, it's really tough to replicate what they've got. So you need to apply more technologies to make factories more efficient. And efficiency almost always goes to, resource reduction, waste reduction, and more often than not is something that, we can invest in. So I think that's an interesting space. You just saw earlier this week China restricting certain mineral exports that are important for metal manufacturing and semiconductor manufacturing. I think there'll be more mineral and metal extractive industries kicking off in the U.S. and there's an ever-present need to make those cleaner and more efficient as well. And so I wouldn't be surprised if we see sort of a resurgence in those sectors, but using the latest technology, which is, always interesting, but not the fastest. The mining industry is not a very fast to adopt new technology kind of sector. They're very, everyone wants to be first in line to be third to adopt a new technology. And so that's challenging. But I mean, let's face it, mining is an incredibly energy intensive sector. And if you have technologies that can make it more effective to discover, extract, refine different materials, that the clean tech revolution needs, so much the better. There's Bloomberg reports out there that say by 2030, we're going to have about half the copper we need for the electrification processes we were already underway with. So those are dramatic. But that's an upcoming trend. And just there's the ever-present trend of just do more with less. So improving circularity. We have a company called Amp Robotics that focuses on, single stream recycling, separation, and sortation. Being able to pull 90% of recyclables out of unsorted trash is something that humans really bad at, right? My family, who knows better, still gets it wrong half the time. I find stuff in the recycling bin. I find stuff in the trash bin. They should be in the opposite bins. And, most of the country doesn't separate even that much. So all of these things folding together, there's just a push for more, resource efficiency over time.
Yeah, no, great. Absolutely. What about your view on kind of food and some of the food systems kind of space, as it were? Because I noticed you did invest in, I think, one or two kind of alternative protein companies, I think, within there. So, how do you feel about not just that sector, but, just the food and ag sectors?
Yeah. Food and agriculture is an absolutely huge sector. It's a third of our GHG emissions, at least, depending on how you slice and dice it. Our food company is a company called Meaty Foods. They do mycelium-based alternative proteins, so meat substitutes that really, really look and taste like meat. And there's 4 or 5 ingredients, very natural, minimally processed, and super healthy. So they're delicious and super healthy. But most importantly, on a grams of carbon per gram of protein basis, there's not much that's lower. Mycelium is a fermentation-based process that basically can eat sugar or other carbohydrates and churn out proteins. And so from a land footprint perspective, from a water intensity perspective, from a carbon intensity perspective, there's really not much better. We're talking huge orders of magnitude better than animal protein, but yet it's still a complete protein. So it's as complete for humans as you can get. And so, that's an incredibly interesting sector. But right now, alternative proteins in the U.S. it's only a few $1 billion a year of market size, which it's growing. It's got double-digit CAGRs. But the other places we're looking at agriculture, we have a company that takes basically the agricultural residue after harvest, what's left on the field, and converts it into a stable form of carbon. It's called biochar, and that company called Applied Carbon. If they took all the stuff that's left after you harvest corn, called corn stover, so the stuff that's literally left in the field, if you convert all that to biochar in field, you're talking gigatons of sequestration. And as a helpful byproduct, it makes the land much more healthy. It's a form of regenerative agriculture. Retains more nutrients, retains more water, just makes the soil healthier. So that's like a win-win-win on that front. And there's other technologies. Remote sensing for better land management, plant the right thing in the right place at the right time, all sorts of better. And, one of my old companies from my prior fund is doing, called Pivot Bio. They're doing bio-based fertilizers. So instead of trying to figure out how you're going to make hydrogen cheap and get nitrogen, footprint, nitrogen's footprint reduced, use nature's naturally evolved microbes to do your nitrogen fixing right out of the air. So it's hard to beat that again. So yeah, there's a lot of different technologies that can be applied to different parts of the food and supply chain. We have one that we're working on right now, which is focused on waste reduction along the supply chain, because 10 to 30% of the food is lost between farm and table already. If you can just reduce the food lost, you're reducing the carbon footprint and land footprint and everything else of the entire supply chain. So we're super excited about all parts of that.
Yeah, no, thank you for that. And just like final quick question just came to mind. How many boards can you sit on effectively to do a really kind of good, effective job?
So I think depending on level of activity and the nature of the boards and the size of the boards and all that stuff, I personally think 8 to 10 is saturation for an investor who's engaged. And I think I'm on 8 right now. So we're definitely pushing the upper bounds. So one of the things we're doing is continuing to grow our team as well, and do some load balancing around that. This is part of the thing you get wrong when you're actually starting a company or starting a firm. We had assumed that part of our model would be to hand off our board seats and the reins to these companies we helped seed to later stage investors. For a variety of reasons, that hasn't really happened all that much. In fact, in some cases, we've gone the opposite way. Started with no board seat, taken one board seat at some point along the way, and then taken second board seat even later. When you have a lot of conviction, you really want to help these companies as much as possible. And so we've modified our staffing and our team build model to account for that. So yeah, an 8 to 10, my take.
Yeah, look great. No, thank you for sharing. Look, I could talk to you all day, but I suppose sitting on 8 company boards, then I shouldn't keep you much longer. So Josh, I just wanted to say thanks a lot for coming on, sharing your journey, and some of your really unique perspectives with the work you do at Congruent Ventures. So really inspiring to hear how some of these early stage investments can make such a lasting impact in tackling climate change and the climate crisis. So listen, thanks so much for coming on today.
Yeah, happy to be here, and thanks for having me.
Pleasure. And look, to all our listeners, we hope this has been a conversation you've enjoyed, and be sure to stay connected for more stories of innovation and impact. Thanks for listening, and we'll see you next time.